Welcome to TMS Insights. This is our second during the August reporting month. Ben Clark and Jeremy Hook bring you a lot of the company news that's come out in this season. So we've had a lot. We'll get straight into them. Ben, one since we last did the Insights video with Seek.
Yep.
Always interesting hearing Andrew Bassett speak. The numbers were good, but again, it's a story about growth, investment in the international business and the future.
Yep, I think you summed it up well. I mean, I thought the highlight of this result was that they grew earnings for the domestic business by 15%, despite the employment market slightly deteriorating during that time. So that was a great effort for management. Bassett, again on the call, said that he believes Xiaoping and Seek Asia will both be bigger than the Seek domestic business at some stage in the medium to longer term, which I think means there's more upside in the share price if he's right. And probably the interesting thing was because we look at these presentations every 6 months, there's some new slides in there this time about human capital management, and they're clearly starting to move towards, the freelancing and this new way that the labour market's going globally, which potentially could be a big thing, but will take time to play out. So still think it's a really well-managed business.
Yeah, good long-term buy there and a stock we very much like. One that was only out today, Isentia, which... Again, coming into the result, it underachieved in terms of share price performance. The numbers were good and the outlook statement positive, so they've had a bit of a lift today.
Yeah, I thought it's a good result, and the outlook was actually a bit ahead of where I thought it would be. So the company's guided for sort of mid-teens in terms of earnings per share growth, and that's actually out to 2020, which you don't often see companies sort of go that far out. And I think that's a tick of sort of confidence that the management has in the business. The numbers were good, but well forecast to the market, and I think it's like one of the better sort of price growth stocks around.
Yeah, and Blackmores was an interesting result. That was out today.
Interestingly,
on the face of it, the numbers, not a small miss, I think, on terms of the analyst consensus estimates, but a comment about the current quarter and that the transition from sales in the domestic market to other channels is causing a bit of a destocking at the retailer level at least, and that's going to hurt this quarterly number.
Yeah, look, and we're meeting the CEO tomorrow, so we'll know some more after that. But what appears to be happening is that supermarkets and pharmacies that were selling these products like hotcakes over the last few years suddenly saw a slowdown in sales as the Chinese look to buy through different channels, and they've therefore decided to carry less stock, which has seen hopefully a temporary drop off in sale volumes. So the share prices reacted pretty savagely, I think you'd have to say. And if we still have confidence that this is really a China-facing business now, and the customer in China, from all accounts, still wants these products. It's just tricky at the moment to get them through to them because the regulatory changes that are happening in China. And that could continue to be the case for the next 6 to 12 months. But I think if you look further out, there's still a lot of growth for a business such as this.
Yeah, good one. CSL we didn't speak about last time.
No.
That was out last week. And again, this wasn't ever going to be a year of the great earnings growth. It was an investment year for them, as they've tended to have, an investment year, then a real earnings growth year. But the story is terrific, really, Ben.
It is. I think also the flu business that they bought a year and a half ago now is still a drag on earnings at the moment. Won't be break even until 2017-18, and will start to contribute to profits looking forward after that. Look, I think we probably agree it looks fairly expensive at the moment, trading on sort of 28, 30 times earnings, but the earnings outlook is accelerating, and they're going to have about 15% earnings growth they forecast this year versus 5% last year, and there's some new products coming to the market, so the next few years in terms of the growth side of the business should be pretty good.
Yeah. And while we're sort of loosely in that space of healthcare, the result out today was Certex, and it was a really good set of numbers and well received.
Yeah, look, a much more speculative stock and not for everyone, but this is a company that manufactures a treatment for liver cancer. It is a one-product company, but very strong sales growth yet again, very strong profit growth, some big clinical trials that will be released this year. And some real evidence that the treatment the company offers is slowly being moved to a frontline treatment as opposed to the current salvage treatment setting. So, a lot I thought to be encouraged about, but again, at the riskier end of the spectrum.
Yeah, sure, that's a good one. The Invacare was a very interesting set of numbers. Good to see. People do tend to laugh when we talk about a funeral service operator and crematoria owner, but numbers were good and some real growth out of their US investment, their US business.
Yep.
But again, a terrific company we've held for a long time.
Yep, it's been a great long-term performer. It goes through these periods of slower sales growth versus faster sales growth. We've had a warm winter on the eastern seaboard and apparently a very effective flu shot this year, and therefore, fortunately, less people have passed away. So, it's a pretty reliable business, and unfortunately, that number will sort of catch itself up, and still, I think, is a good long-term business to own.
Aveo in the retirement business, AOG, one held in our Adam Smith portfolios, and otherwise it's been a good set of numbers, a good jump, Ben, on that result.
Yeah, operates a lot of the over 55 villages, really good management, very good operators. One that has, as Icenti has just done today, actually set themselves some quite meaningful sales targets looking further out, which you don't see enough of in the market, and has continued to hit and exceed them. And they're, also did a capital raising and announced the purchase of the remainder of a portfolio of buildings that they own. They think they can sort of operate a
sensible acquisition. It was made.
So plenty to like, I think.
That was good.
Result. Yeah.
A big stock, obviously widely held. Wesfarmers report out today always has different parts, being a conglomerate. Great growth from the Bunnings business. Coles actually reasonable, but we're a little bit unsure about how that's going to progress going forward. And although the numbers were a slight beat to consensus, the dividend was less than expected. And Ben, probably the game gets a little bit harder for Wesfarmers overall at the moment.
Yeah, I think the Bunnings business is going along wonderfully, and that's about 30% of earnings. But I just think Woolworths seems to be really getting itself back on track in grocery, and prices much more competitive, and the supermarkets starting to be run much more efficiently than they have been, and the sort of the free kick that Coles had over the last few years might be sort of running out of steam, and competition coming back. And Goyder, the CEO, was certainly a bit more cagey about the outlook for the supermarkets business going forward, and we might be seeing finally a resurgent Woolies.
Yeah, that's good. And Woolies report tomorrow, but we did get guidance from them recently, and we also got news today about what they're doing with the sites of the Masters business, and also the sale of the home timber and hardware to the Metcash group, which, again, significant announcements.
Yeah, and selling, I believe, their petrol stations. The pubs business apparently is on the portfolio. It might be sold out. So they just seem to be simplifying and concentrating on what they used to be so good at back in the day, and
shrinking to succeed, really.
Right,
Back to core activities. Now, one that is not a good result, and one that's been a poor performer, has been QBE.
Yeah,
that was not a good set of numbers after a pretty reckless few years, really.
Yeah, look, it's been a frustrating one in that we continue to, the biggest thing. Well, there's two factors out there. The first is interest rates in bond markets have continued to fall, and the investment income this company is receiving continues to come under pressure. And with 1/3 of bonds now on a negative yield, you keep thinking that can't get any lower, but it keeps getting lower. So that's been an issue for the company. And the second has been the CEO did call out that there hasn't been a major hurricane in the Gulf states of America for 4 years now, and they've seen a lot of smaller competitive players come into that market as a result. And he almost, sort of said we need something like that to wipe out those lower cost operators and allow us to put our premiums up to where we believe they should be. So, there's a few factors there, and I think you're right, Jeremy. It's sort of one step forward and two steps back at the moment, isn't it?
It is. Two that we did like in this season, and we're actually keen and on the front foot buying, really, aren't we? Is Challenger and Vocus. Let's look at them both. Challenger, we did talk about it the last insights, but again, they've pulled back a little bit in share price terms. So better value, a good diversified financial. But Vocus, emerging from a big and busy year, but that was a result where we get that confidence you don't always hear from management.
Yep, definitely. I mean, Vocus, a lot of clients probably haven't heard of. It's the amalgamation of three businesses, which was Vocus, which owned the fibre network that runs around the major cities on the eastern seaboard. It's a corporate business principally, and most of the buildings there would use the Vocus network for their ADSL requirements. And then Amcom, which owned the Perth and the western seaboard, identical sort of assets. And then, so they merged, and then they took over a company called M2 Telecommunications, which owns an SME business called Commander, and retail businesses, including iPrimus and Dodo. And look, it was a bit of a messy set of numbers because they all got thrown in there today. And since then, Vocus has also bought a business called NextGen, which owns the fibre networks that connects the major cities around the country, and they call out the missing piece of infrastructure that they've needed. And that, look, I thought the result was very good. Yeah. The retail business grew faster than its competitors, particularly as customers transitioned to the NBN. The SME, I think the biggest thing I take out of it is that the businesses combined, there's huge cross-selling opportunities. Commander, which might have done phones for a mid-sized business, didn't have the bandwidth capacity to do their ADSL. They can now walk in and sell the Vocus network to those companies, and vice versa. So there'll be a lot of opportunity that's opened up through this. And you're right, Jeremy, like the CEO was very confident on the core of continued very strong growth. And it's come back to a level now, which I think is pretty appealing.
Yeah, so it had that capital raising for NextGen at around 755 a couple of months ago. It's now trading in that 830 sort of band, and that's a pretty good level. So that's a good one in the wash up of the reporting season. We've got more reports coming in the next few days as August winds up, and we will bring you some further news when it's due. That's all for today, though.